Here's a question that sounds simple but almost nobody can answer. How much insurance do you actually need? Not do you need insurance? We've covered that. Not which type, we'll get there. The question is how much? Because getting insurance with the wrong amount is almost as bad as not having it at all. Too little and your family is still exposed. Too much and you're paying for the coverage that you don't need. Today, I'm giving you the exact formula and you'll be able to calculate your number by the end of this video. Pen and paper ready? Let's go. Most financial advisors skip this step. They ask you, what's your budget? And then reverse engineer a product that fits your wallet. That's not architecture, that's retail. A wealth architect starts with a number. What is the actual financial exposure your family faces if something happens to you? We calculate that first, then we design the coverage around it. The formula I'm about to show you is called the human life value approach. It's the method used by financial engineers and actuaries worldwide. And I'm going to simplify it so that anyone, regardless of their financial background, can calculate their own number in 15 minutes. I also built a free worksheet you can download. Link will be in the description. But first, let me walk through the logic so you understand why each number matters. 3 steps today. First, the human life value formula, the core calculation. Second, 3 scenarios. I'll run the formula for a 30,000 earner, 80,000 earner, and a 200,000 earner so you can see how it scales. Third, the coverage gap analysis. How to compare what you need to have and what you have and what to do with the difference. Here's a concept that changes how you think about insurance. You, the person watching this, are a financial asset, not in a cold, dehumanizing way, in a practical way. Your ability to earn income is the most valuable asset your family has. If you earn 40,000 a month, that's 480,000 a year. Over the next 20 years, that's 9.6 million pesos. And that's the income your family depends on. If you disappear, that income disappears with you. So here's the human life value formula. Step 1, annual income. Your gross annual income, not take home, gross, because benefits and bonuses and employer contributions are also part of your value. Let's use 480,000 pesos per year. Step 2, working years remaining. How many years until you plan to retire or until your youngest dependent is financially independent, whichever is longer. Let's say you're currently 25 and you're retiring at age 50, so that's 25 years. Step number 3 is to multiply that. So 480,000 times 25 equals 12 million pesos. That's your raw human life value, 12 million pesos. Step 4, add major obligations. Now add specific obligations like outstanding mortgage, children's education, and existing debts. Let's say 2 million pesos for the mortgage, 1.5 million education fund, plus 500,000 pesos for the other debts. That's a total of 4 million pesos. Step number 5 is subtract existing assets. Subtract what your family can already access. Existing savings, investment, insurance, spouse income if applicable. Let's say 800,000 in savings, 200,000 in investments, and 0 existing coverage. So you have 1 million pesos. So your coverage need is 12 million pesos plus 4 million pesos plus 1 million pesos equals 15 million pesos. 15 million pesos, that's the coverage gap for this scenario. Now, does that mean you need exactly 15 million in coverage right now? Not necessarily, but it tells you the target and it tells you how far your current coverage, which in this example is 0. Malaki ang gap, di ba? That's the point. Most Filipinos have never calculated this, and the gap is almost always larger than they expect. Let me run this for 3 different outcome levels so you can find the one closest to yours. Scenario number 1, 24 years old, single, earning 30,000 a month, renting, no debt, supporting parents partially. Annual income is 360,000 pesos. Working years, 30. So the raw HLV, human life value, is 10.8 million pesos. Major obligations, no mortgage, parent support fund, 10 years times 60,000 equals 600,000 pesos. Emergency buffer, 200,000 pesos. Existing assets, 100,000 pesos. Existing coverage, none. So, the coverage needed is 10.8 million plus 800 plus minus 100,000 pesos equals 11.5 million pesos. Josh, paano ko afford ang 11 million coverage on 30,000 a month? Here's the key. You don't need to cover the full amount on day one. Start with what you can afford. Even 3 to 5 million coverage closes a massive portion of the gap. As your income grows, your coverage scales with it. The goal today is to know the number because you can't close a gap you haven't measured. Scenario number 2, the 80,000 month earner. 32 years old, married, 1 child, earning 80,000 a month, condo mortgage, company group insurance of 500,000. So annual income is 960,000. Working years remaining, 25 years. Raw HLV is 24 million pesos. Major obligations, mortgage balance of 3.5 million, child's education of 3 million, spouse adjustment fund, 1 million pesos. Existing assets, savings plus investment, around 500,000 pesos. Company group insurance, 500,000 pesos. Spouse's income, 400,000 per month times 10 years, that's 4.8 million pesos. So calculation, so the coverage need is 24 million plus 7.5 plus 5.8 million. That's a total of 25.7 million. 25 million and the company group insurance, 500,000. That's 2% of what this family actually needs. This is why I always tell my clients, company group insurance is a supplement, not a solution. It's a band-aid on a wound that needs surgery. Scenario number 3, the 200K per month earner. 40 years old, 2 kids, business owner, earning 200,000 pesos a month, house fully paid, some investments, no existing personal insurance. Annual income is 2.4 million pesos. Working years remaining, 20 years. So the raw human life value is 48 million. Major obligations is business continuity fund, that's 12 months of revenue, equals to 10 million pesos. 2 children's education, private school plus university abroad, 8 million pesos. State tax provision, 2 million pesos. And spouse lifestyle maintenance for 10 years equals 5 million pesos. Existing assets, they have a savings plus investments of 5 million pesos. Properties that's illiquid, so they cannot be accessed quickly, so 0. Existing coverage, 0 as well. So here's the calculation. Coverage need is 48 million plus 25 million plus 5 million equals 68 million pesos. 68 million. And this person, a successful business owner, currently has 0 coverage. This is more common than you think. The wealthier the client, the larger the gap because the obligations scale with the lifestyle. Look at these numbers and now think about how many Filipino families have coverage that even comes close. Now let's talk about what to do with your number. That red space, that's the risk your family carries every single day. Your coverage gap analysis is 1 page, 5 numbers. Let me walk you through it. Line 1, your human life value. Line 2, plus major obligations. Line 3, minus existing assets and coverage. Line 4 equals your total coverage need. Line 5 minus your current insurance. Results, your coverage gap. If your gap is 0, congratulations, you're fully protected. And that's rare. If your gap is positive, and for most Filipinos, it's very positive, that's the number we need to engineer a solution for. Now, closing the gap doesn't have to happen in one move. Think of it as a journey. Phase 1, get foundational coverage. Close 30 to 50% of the gap with an affordable annual investment. This is your minimum viable protection. Phase 2, as your income grows, increase coverage. Most wealth architectures I design include annual review points where we reassess and adjust. Phase 3, at peak earning years, close the gap completely. Full coverage plus full legacy planning plus estate tax engineering. The mistake is not getting the wrong product. The mistake is getting 0 because you were waiting for the perfect amount. Hindi kailangan perfect, kailangan may simula. This seems like a lot of insurance. Are you just trying to sell me a big policy? No. I'm showing you math. The math doesn't care about my commission. It cares about your family's exposure. You can take this formula, run it yourself, and decide your own coverage amount. I'd rather you be informed and buy from someone else than uninformed and buy from me. My company has group insurance. That's enough, right? Run the numbers. Most group insurance covers 1 to 2 times your annual salary. If your coverage need is 25 million and your group insurance is 500,000, you're at 2% coverage. And group insurance disappear the day you leave the company or get laid off. I can't afford the coverage I need. You can afford to start. Even 20% coverage is better than zero. And with the right wealth architecture, your coverage grows as your income grows. The system scales. You now have the formula. You can calculate your own human life value and coverage gap right now. But to make it easier, I built a free worksheet. It walks you through every step, income, obligations, assets, gap calculation, in a simple one-page format. Download it from the link in the description. And if your gap scares you, which it probably will, let's talk. Book a free consultation and I'll show you how to close that gap with an architecture that fits your budget and your goals. There's no pitch, just a month. Next week, I'm going personal again. I built Team Aquila 11 from zero and I made every mistake in the book. Leadership lessons at 28, honest, raw, and useful, whether you're building a team in your financial advisory or anywhere else. Again, this is Josh, your family's future engineering. See you next Saturday.